Hi again, class. I wanted to take a moment to expand a little bit on the accrual versus cash method of accounting, hit on some key points, and also relate this for you to the adjusting that you're doing in the lab by visiting the study plan and going through a couple of those problems with you. So I wanted to start out just by differentiating between cash versus the accrual method of accounting. What you will find is that most businesses use the accrual method of accounting. Not only is it required for publicly traded corporations, but because of the fact that it does give a better reflection of profitability in the income statement, it's going to be the preferred method. Some of the smaller businesses, not publicly traded companies, can use the cash method, a proprietorship or a small partnership, for example. There are a couple of underlying generally accepted accounting principles met by the accrual method that are not met by the cash method. These are the matching principles and the revenue recognition principles. And so really the difference with the cash and the accrual method is going to be the timing in which we recognize accrued and deferred expense and revenue transactions. So basically what I mean by a deferred revenue or expense transaction, a deferral happens when the money changes hands before the transaction occurs. So if you're paid ahead of time, for example, for work that you haven't performed, then that's deferred revenue. If you prepay for rent or another type of expense, maybe insurance, also that's a deferred expense. Money happens before the actual transaction. On the other hand, we have accrued expense and revenue transactions. Accruals are when the expense or the revenue happens before the money changes hands. So for example, when you provide a service for your customer on account, you've earned the money before the bill has actually, or the invoice has been paid, that's accrued revenue. Or when an expense accrues, such as employees working hours, of course, before they're paid, that would be an example of an accrued expense. In the cash method of accounting, we really do not recognize revenues or expenses until cash actually changes hands. So I do not recognize the earning of a revenue until I've actually been paid for the job, and I do not recognize expenses until I actually pay those out. So what happens is revenues and expenses can be recorded in separate accounting periods, which gives a less accurate representation of my ability to produce profit. So for example, if I do a big job for a customer and it takes them 60 days to pay, chances are pretty good that the expenses that I've incurred toward this job were incurred and paid during that period of performance. So I end up with a lot of expenses showing in my income statement for that period because I've paid those, but no associated revenues or matched revenues because that revenue is not going to be reflected until I receive that payment 60 days later. So the accrual method of accounting is going to accommodate the recognition of revenues when they're earned, the recognition of expenses when they're actually incurred, regardless of whether or not cash changes hands at that point. One thing I want to point out to you, please note there's never a difference in the cash account balance in the accrual or cash methods of accounting. Both are only going to record to the cash account when cash actually changes hands. The difference is going to be recognition of revenues and expenses, accrued or deferred revenues and expenses in revenue and expense accounts. So that's where the only difference is going to come in. One is not going to track actual cash any differently from the other. So because we're able to record or recognize our revenues and expenses when they're actually encountered in that accrual method of accounting, we're going to do a much better job matching revenues with associated expenses, which in turn is going to give us a more accurate representation of our ability to produce profit. So the next question that comes up is, well, how does this happen then? How do we recognize items when we haven't actually had that cash change hands? And this is where your accounts receivable, and your payable accounts come into play. So let's look at an accrued revenue and an accrued expense example and kind of compare the accrual method with the cash method. So for instance, let's say we perform a service for a customer on January 15th, but that customer doesn't pay us until March 30th. In the cash method, what happens here is that because we only recognize the earning of revenue when cash changes hands, nothing is recognized in January. It's only at that point on March 30th that the customer pays us that increases our cash account by the amount of payment, and we recognize the earning of that revenue. However, in the accrual method, we're going to recognize that revenue when earned. So that creates an accounts receivable for that customer to show what our customers owe us for services that have been performed that have not yet been paid. And we recognize the earning of the revenue with a credit to service revenue at that time. So that allows us to allocate this revenue in the appropriate month in which it was actually earned. So when we receive the cash payment on March 30th, essentially all we're doing at that point, we're not recognizing revenue again, we're just settling that receivable that we created on January 15th. So what happens here is we accept or receive that cash in $750 and we credit that accounts receivable account $750 to eliminate that receivable from our books. On the other hand, let's say we incur a wage expense that we do not pay until a week later, which is very common, right? But it's very important that we recognize that wage expense during that time it was actually incurred, because when we hit that point at the end of the month, for example, where a portion of wages should be allocated to that particular month, we don't want to allocate that to the next month simply because that's when we're paying it. So what happens here on January 15th, even though we're not paying until the 22nd, we're going to go ahead and accrue this wage expense by increasing the wage expense $750 for the amount of wages earned that week. And we're going to increase a wages payable account, which becomes a liability for us. So our balance sheet will now show that as of January 15th, we owe employees $750 in wages. So when we pay that, sorry, I didn't change my date here. That should say January 22nd. But when I pay this liability, I'm simply settling this payable. So that's going to decrease that wages payable by $750 and decrease my cash asset by $750. In that cash method, we're only recognizing expenses when cash changes hands, so we do not recognize or allocate that expense in a different period if that's the case. If that's when it incurred, we're only going to recognize that at the point of payment. So in the cash method on January 22nd, we recognize a wage expense and we recognize the decrease in cash associated with that wage expense. So as I mentioned, I wanted to jump into the lab with you and look at a couple of these items to hopefully, clarify how you're applying. What happens basically is when we do have that option, or when we are using the accrual method and we are recording accrued and deferred expense and revenue transactions, essentially what happens is at the end of a period, we have to use adjusting entries to ensure that the appropriate amount of revenue and expense are allocated to that reporting period. So wanted to go through a couple of these items with you in our study plan, because if you have not yet looked at the study plan in the lab, I would highly encourage you to do so. You can go into the study plan and you can choose specifically what you want to work on, and it will give you that repetition and that practice to help you master these concepts before you go into your final attempt in the homework assignment and apply these concepts for the graded portion of the task. So the study plan is available to you. You can work in any topic as many times as you need to gain that repetition and practice to prepare you accordingly for those weekly homework tasks. So in the study plan, I'm looking at a problem here that's asking me to basically adjust my supplies account to show the amount of supplies that should be expensed for the period. It asks me first to open the office supplies T account and record the beginning balance, then to record my adjusting entry as of November 30th, and then to post that adjusting entry to the two accounts that are affected. So the information it gives me says on November 1st, we had a beginning balance in office supplies of $16. $1,600. So I want November 1st. I've got an increase of $1,600, or at least I have $1,600 in office supplies. An increase to an asset is a debit, right? During the month, I purchased $1,900 more in office supplies. So I've got November purchases, increases supplies by $1,900. And then as of November 30th, then I'm going to have $400 of office supplies on hand. So this should be sufficient. I haven't worked in the lab in a little while, so I might have to fix this. Okay, it didn't ask anything. Just wanted to make sure. I was thinking I didn't need to put my adjustment in the ledger until afterwards. So it's asking me to adjust to show that I have $400 in office supplies left as of November 30th. So it's not giving me the amount of the adjustment. It's telling me what my balance should be. So in this case, what I'm doing when I adjust these supplies is, again, I'm showing the amount of supplies that were used, which would be a supplies expense for the period. Looks like I had $3,500 in supplies. Here I have $400 in supplies left due to a physical count, so that would be $3,100 in supplies expensed. And I want to decrease my office supplies asset account to, of course, bring that down from the $3,500 balance I have in my ledger to the $400 balance that it should be. So I think that's all it needs from me. Oh, what is it asking? I need an explanation. Okay, so let me go down to my explanation to record office supplies used. All right, and then basically this next section is really just going to have me post here to the ledger to show that difference. I'm going to have that credit on November 30th in the amount of $3,100, which is going to, effectively bring my balance down to $400. But because I have one more example that I want to show you and only a little over 2 minutes left in my 15-minute recording here, I'm going to jump to the next problem. And this is having me basically calculate the depreciation on my computers. And I'm going to have to adjust for depreciation, however frequently I am closing my books, whether that's monthly or whether that's quarterly or whether that's annually. So it says on August 1st, I paid cash $122,400 for computers, expected to remain useful for 6 years. And at the end of those 6 years, the value of the computers is expected to be 0. So it asked me to first calculate the amount of depreciation for the month of August using straight line. So I'm looking at, let me grab my calculator. I'm looking at $122,400 in computers divided by 6 years. That's $20,400 per year. So per month, that's $1,700. And I'm recording only for the month of August. Okay, so let's see. It's asking me to begin by selecting the labels and enter the amounts that you want to compute. Okay, we're looking at no salvage value. So, I should have done this beforehand. So we're looking at cost less any residual value divided by useful life. So cost minus residual value divided by useful life is how we determine straight line depreciation. So here we're looking at $122,400, no residual value, 6 years useful life. We get $1,700 in depreciation. So what we're going to do to record this, or to adjust for, because what we're doing through depreciation is allocating the cost of this asset over the life of this asset to meet that matching principle. This asset is going to provide us benefit every month over the next 6 years, so we want to expense it out every month over the next 6 years. The way we do this is increasing the depreciation expense by the $1,700 for the month, and that difference goes into the accumulated depreciation contra account, which will bring the book value of that asset down on the balance sheet to record depreciation on computer equipment. All right, so hopefully those examples were helpful. I'm about at the end of my allocated time here, or allotted time. So as always, please do not hesitate to get in touch with any questions that you might have. Hope to see you guys soon in our weekly discussion.